If you want to get started investing as a complete beginner, there are a few key decisions that you need to make before jumping in. Today, we'll cover all of those key decisions step by step, so by the end of this video, you'll be able to make your first investment. Investing at its simplest definition is just the act of using existing assets, like cash, to generate even more assets. Typically, the higher the potential return, the more risk an investment carries. There are many different ways to invest. You probably clicked on this video thinking about stock market investing, which is by far the most accessible and easiest one to get into, but you can also invest in things like real estate, peer-to-peer lending, silver and gold, cryptocurrency, and if you're wealthy enough, startup companies, like the premise of Shark Tank. This video will focus on stock market investing, but it's good to still be at least somewhat knowledgeable on the different alternative investment options, because as you grow your wealth, you might want to consider diversifying your assets. Nearly all types of investing carry some amount of risk, but if you're methodical in your approach and you don't make too many emotionally charged decisions, investing is one of the best ways to grow your net worth in the long run. In fact, I would argue that investing is the only way to meaningfully increase your net worth over long periods of time. Hoarding money in a savings account, even some of the savings accounts which have yielded up to 2% returns in recent years, will cause you to lose money in the long run because of inflation, which historically tracks at about 3% per year. So while your dollar amount saved might go up, the value of those dollars will go down. Investing is a great way around that because it gives you the opportunity to not only match inflation, but beat it. Right, so let's look at the stock market. How does it work? Is there a magical man behind the curtain pulling all the strings like Wizard of Oz? Short answer, yes, but really no. The stock market is essentially a very broad and somewhat intangible auction house. When a company goes public, which is also called an initial public offering or IPO, that means that that company is joining the stock market by allowing the average investor to purchase shares of their company's stock, thereby giving them a huge influx of cash needed to grow their business. For any given publicly traded company, there are a set number of shares out there. The value of those shares come down to basic supply and demand. When there are more people who want to purchase those shares than there are people willing to sell them, the value of that stock will go up. Likewise, if everybody wants to sell their shares but there's nobody willing to buy them, the value of that stock will go down. By owning stock in a company, you're technically a part owner of that company, so you own a very, very, very small fraction of that company. Does this mean that by investing in Tesla stock, you get to tell Elon Musk which next supercar he needs to build? No, not at all. So then why would someone want to own company stock if they can't actually make any real decisions that affect the business? Well, as a part owner, you're entitled to a very small percentage of the profits that the company makes. These profits are paid out to you usually on a quarterly basis in something called dividends. Not all stocks pay dividends, however. Some companies choose to reinvest their profits back into the business, so there aren't any dividends to pay out. However, as an investor, this can still be a really good thing if the future growth of the business causes the value of that stock to increase. The perceived value of these stocks, whether it's from the dividends that they pay out or the predicted future growth of that company or both, this perceived value is ultimately what drives the price of those stocks. That's why you'll see the stock market fluctuate during stressful world events. For example, when the pandemic first started early last year, the stock market took a nosedive because people lost confidence in the future of these companies. But as the world adapted and we learned more about the virus, the stock market rebounded quite quickly. In fact, the S&P 500, which tracks the performance of the largest 500 US stocks, is now well above where it was before the pandemic started. Remember, if you're invested in the stock market and it crashes overnight, technically, yes, your net worth has gone down. But you don't actually solidify that loss until you sell off your investments, thereby exchanging them for cash. People who sold everything during the crash at the beginning of the pandemic lost a lot of money because they wrongly believed that the stock market would continue to go down and never recover. Is that a risk? Well, of course it is. Investing always carries some amount of risk. But if you have strong financial safety nets in place and can ride out a crash without touching your investments, you can mitigate a lot of that risk. That's why it's crucial that you follow these steps that we're about to go through because you want to be prepared for every possible scenario. The very first thing you need to do before you start investing is, well, decide whether you're ready to start investing. I'm of the opinion that investing can and should be accessible to everyone, regardless of your financial situation. Growth takes time, and the sooner you start investing, the longer your money has to experience compound growth, which is when your gains make more gains, which make even more gains. However, there are a few things that you need to consider before you get started investing. I call this the pre-investing checklist. First, do you have any high-interest debt, usually something like credit cards? The interest rates on these debts will almost always be higher than the gains that you could realistically expect to get in the stock market. For example, the average credit card interest is anywhere from 15 to 30%, whereas the stock market historically only returns an average of about 8 to 12%. Therefore, if you invest in the stock market instead of paying off credit card debt, you'll lose money in the long run. If you have high interest debt, you should make it your priority to pay it completely off before you get started investing. Next, ask yourself if you have a comfortable emergency fund. This is money that's immediately accessible in times of emergencies, like your car breaking down or losing your job. Having an emergency fund is really important before getting started investing, because you do not want to be in a position where you have to liquidate your investments in order to pay rent. Third, go through your budget and see how much money you have left over after expenses and other financial goals. If you have cash left over, that's money that you can put towards investing. If you don't have cash left over, consider ways to either decrease your expenses or increase your income. Fourth, and possibly the most important, ask yourself whether you can emotionally and mentally handle watching the value of your investments drop in half overnight. For the average investor, this is not a common occurrence, but investing is for the long term. And if you're young, there's a very good chance that you might experience a stock market crash at some point during your life. Prepare yourself for that eventuality now, and it's less likely that you'll make a rash decision that causes you to lose money, like selling when you don't need to during a crash. Once you've checked off every single item on that list, you can get started investing. You'll first want to decide on what type of account you want to invest in. Different accounts have different rules, and some accounts offer really great tax benefits, so it's important to choose the account that makes the most sense for your situation. The most basic option is your standard taxable brokerage account. In these accounts, you have to pay taxes on gains that you get when you sell off your stocks. You also don't get any tax benefits when you contribute to the account, like you might in some other account types. That's why, as a beginner investor, I strongly recommend investing in a Roth IRA. IRA stands for Individual Retirement Account, and it offers a serious tax benefit: no taxes on growth. So if you invest $500 a month for 30 years, assuming a 7% return, your investment portfolio would be around $580,000. If you invested using a taxable brokerage account, you would have to pay about $100,000 or so in taxes. But if you invest in a Roth IRA, that entire amount is yours to keep completely tax-free. You're only allowed to contribute $6,000 a year, and there are a few other rules, so be sure to check out my other video on everything you need to know about Roth IRAs, including how to set one up. Other common investment account options are retirement accounts sponsored by your employer, so things like 401ks or 403bs. In these accounts, you're usually somewhat limited on what you can invest in, and they have slightly higher fees compared to a Roth IRA. However, they also offer really great tax benefits, either when you put money in or when you take money out during retirement, so they're way more tax efficient than your standard taxable brokerage account. Some employers also offer 401k matches, where they'll match your contribution up to a certain percentage or dollar amount of your salary. This is an immediate 100% return on your money, so you should prioritize hitting your employer match before investing in any other type of account. So essentially, your very basic order of prioritization should be the following. First, meet your employer's match on their plan if offered. Second, max out your Roth IRA. The current limit is $6,000 a year. Third, max out the rest of your employer's plan for those great tax benefits. Currently, the 401k limit is $19,500 a year. And then finally, if you still have money left over after all of this, you can invest that into a taxable brokerage account, which has no limit. This order maximizes your return and minimizes the amount of taxes that you have to pay. If you don't have access to something like a 401k or 403b, then you would just max your Roth IRA and move on to a taxable brokerage account with any leftover money. There are also a few other investment account options that I did not include here, like HSAs or 529s, which allow you to save for your child's college future. So those will fit into this list somewhere depending on your own personal situation. Next, you'll need to decide on a brokerage. A brokerage is basically like a bank for your investments. They act as a middleman and enact all of the transactions that have to take place in order for your money to then be invested in the stock market. If you're investing in an employer-sponsored plan like a 401k, you won't have a choice about which brokerage you can use. You'll have to use whatever brokerage your employer is offering. If you don't know which brokerage that is, consult your onboarding documents or contact your HR department to help set that up. However, if you're investing using a Roth IRA or a taxable brokerage account, you have the freedom to choose whatever brokerage you want because those accounts are not tied to your employer. There are dozens and dozens of brokerages out there, and personally I categorize them into two types. First, your more established brokerages that have been around for decades, and second, your newer, more mobile-focused brokerages that are trying to appeal to a younger market. Of the first group, the three main brokerages are Fidelity, Vanguard, and Charles Schwab. The big benefit of going with a more established brokerage like one of these three is that they have a long track record of managing investments, and they tend to have a larger infrastructure, making them generally less susceptible to technical or security issues. The con, however, is that they're generally a little bit less user-friendly. These brokerages have been around for decades, long before the internet was even invented, so they used to be operating solely as brick-and-mortar stores where you could go in and talk to a real person who could then transact your investment for you. Thus, when these brokerages started offering online services, they brought with them a bunch of different options and features that really bogged down the UI, and these are things that the average investor will probably never need. Of the three main brokerages, I would probably say that Charles Schwab has the most beginner-friendly user interface, although there is some amount of learning curve. On the other hand, if you really want a streamlined user experience and you don't care too much about the long-standing history, you might prefer some of the newer brokerages. Some of the big names in this category are Robinhood, Webull, TD Ameritrade, and M1 Finance. Because they're catering to a younger market, these brokerages have invested really heavily in their mobile apps. So if you prefer to manage your investments through your phone instead of the computer, these could be a good fit for you. However, some of these brokerages have been involved in some scandals and lawsuits recently, like when Robinhood suspended trading of the GameStop stock and caused a lot of investors to lose a lot of money. Or when Robinhood incorrectly showed hundreds of thousands of losses on a young man's account and he committed suicide because of it, but it turned out it was just a technical glitch. However, the bigger brokerages like Fidelity, Vanguard, and Charles Schwab are certainly not immune to these same issues, so it ultimately comes down to personal preference. In summary, you won't get to choose your brokerage if you're investing in an employer-sponsored plan like a 401k because you have to use whatever brokerage that your employer picks. But if you're investing in a Roth IRA or a taxable brokerage account, go with a brokerage like Fidelity, Vanguard, or Charles Schwab if you prefer long-standing history and larger infrastructure, or go with a brokerage like Robinhood, Webull, M1 Finance, or TD Ameritrade if you prefer a more streamlined interface and better mobile support. After deciding on both your account type and your brokerage, you're ready to start investing. Once you have your account set up, you'll need to contribute money to it. Most brokerages allow you to connect directly to a checking account. And if you're investing in an employer-sponsored plan like a 401k, you can usually have it taken directly out of your paycheck. This is the point where I see a lot of beginners mess up, because after contributing money to their account, they stop and do nothing else. A beginner might think that their money is invested at this point, but that's not true at all. Contributing money to an investment account is the first step that you need to take in order to invest, but you need to deliberately go in and choose which investments you want to purchase with that money. If you do nothing, that money is essentially no different than cash sitting in your bank account. It's not exposed to the stock market and therefore it has no possibility of growing. Okay, so you know you have to choose your investments, but which ones do you choose? On the New York Stock Exchange, which is what most people think of when they refer to the stock market, at least in the US, there are over 2,800 individual companies represented. That's 2,800 stocks that you can pick and choose from to build your investment portfolio. And if that doesn't sound overwhelming enough, that number does not include the various mutual funds, index funds, and exchange-traded funds, also called ETFs, that you can invest in as well. These funds hold a collection of individual stocks ranging from dozens to hundreds to thousands, depending on the individual fund. Essentially, by investing in one of these funds, you're investing in a tiny sliver of a bunch of different stocks, reducing the impact of one company going bankrupt and having its stock drop in value overnight. I actually have a video that explains these funds and the similarities and differences between them in much greater detail, and I strongly recommend checking it out if you're a beginner. Some people prefer picking individual stocks to invest in because they really enjoy thoroughly researching companies and only investing in ones that they personally believe in, while other investors prefer investing in things like mutual funds, index funds, or ETFs because of the broad diversification that they offer. Another investment option on the stock market is bonds. Bonds are issued by governments or individual companies. Essentially, the government or individual company is taking out a loan from you, and you're acting as the bank. They pay you periodic payments and interest for providing the loan. Bonds are generally considered a lot less volatile than stocks or mutual funds, but because of that, their potential growth is also a lot smaller as well. Younger investors typically have a very small percentage of their overall portfolio in bonds, if anything at all, and then slowly ramp up that percentage as they get closer to retirement. The philosophy here is that when you're young, you have the flexibility to be a bit more aggressive in your investment approach because you're decades away from needing that money to live off during retirement. But as you get closer to retirement, the stability of bonds can minimize the risk of a stock market downturn that might alter your retirement plans. Ultimately, your investment strategy will be based on your own personal preference and your risk tolerance. And remember, it's not all or nothing. If you really like the broad diversification of mutual funds, index funds, and ETFs, but you still want to invest in a few specific companies that you really believe in, you can do that. Maybe 80% of your portfolio is dedicated to mutual funds, and the remaining 20% is dedicated to picking individual stocks. Your portfolio can also be easily adjusted over time, so don't worry about being locked into whatever approach you decide to start with. Finally, you're going to want to come up with a game plan to take out as much emotion as possible from your investing. It is really, really exciting to make your first investment and watch those numbers grow. But while the stock market has historically performed well over the long run, there are going to be dips here and there. You'll experience small day-by-day dips, and especially if you're a young investor, you're very likely to experience a very large dip at some point during your life. People who lose money in the stock market typically lose money for one of two reasons. They're either over-leveraged in their investments, don't have a solid emergency fund, lose their job, and then they're forced to liquidate their investments, possibly at a loss in order to pay for living expenses. Or they see the first signs of a market downturn, panic, and sell everything. People in the second group particularly think that they have the ability to time the market, meaning that they plan on selling everything just before the market crashes and then rebuying everything just before the market recovers. It sounds great in theory, but statistics show that this rarely works out as intended. Way more often than not, these investors lose out on a lot of money because it's really, really hard to predict a stock market's peaks and valleys. Remember, you don't solidify any losses until you sell. As a beginner investor, take the time now to strategize what you'll do during a stock market downturn. And be sure to have a solid emergency fund that can float you by in times without income, because stock market crashes and increased layoffs tend to go hand in hand. One thing that helps me a lot, I don't obsessively check my portfolio every single day, especially in my retirement accounts. I'm not going to use that money for decades, really, so it doesn't really matter if it's lost or gained $100 in a given day. I honestly only check the value of my investments once a month when I record its number into my Excel spreadsheet and contribute more money to that account. I realized this was a longer video, so thank you so much for watching if you made it this far. If you're ready to start investing, I'll link a few videos up here and at the end of the video to help you get started. If you learned something from this video, please consider giving it a like for the YouTube algorithm and consider subscribing if you want to see more videos like this because I release new content every single week. Thanks all for watching, and I will see you all next week.